Oh, right. Today is Thursday, June 9th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Before we start, a few notes. Note number one, I just released a video earlier today going over the op-ed by President Joe Biden last week explaining his take on the economy and inflation. And of course, the problem that he sees in the economy is it's probably too good and it needs to cool down a little bit. Talk about gaslighting, so go ahead and check that one out after you watch this. But note number two, a lot of you in the comments suggest that I use less profanity because you want your kids to watch the show and learn about the economy and the stock market, etc., etc. Now, I understand your point of view, but the way the economy is going, we're going to need to lose a lot of profanity, a lot more. So unfortunately for now, this show remains an adult show. Maybe we'll do a kids show some of these days, but not right now. So lock up the kids and let's go. In focus tonight, the CPI Preview. And by the way, did the CPI leak ahead of time by the end of the day today? Because stocks were muted, nothing going on, boring. And unfortunately these days, you can't even switch to the Johnny Depp trial. That's over now. So you have to sit down and watch the stock market, even though it's boring and no action is going on, no trades at all. But at the end of the day, we saw an acceleration of selling as if it was a sudden panic or something. So what happened here? Did the CPI leak somehow? Perhaps. For example, listen to this from MarketWatch. The headline reads, U.S. did not get any relief from high inflation in May. CPI to show another big gain. How did you guys know? I mean, I know inflation is going higher, but how are you so sure? Because we got the core CPI, which the Fed is going to look at. We got the month-over-month readings, which the Fed will be concentrated on. And the reason is they're looking for any excuse to say, look, inflation is already cooling down in its own, and our approach is working fine. We don't need to become more hawkish. So let's play a game here and see what areas of the reading, the CPI reading, would be favorable for the Fed and the pumpers and the manipulators, the gaslighters, because they're looking for something to pump equities higher. When we look at the core CPI and core PCE, core PPI, and by the way, I don't look at the core at all. I mean, it is kind of laughable when the Fed says we have to concentrate on core CPI because food and energy are too volatile. Are you kidding me? These two, food and fuel, happen to be at the top of the list of consumer spending, not to mention necessities. So taking away food and fuel and oxygen, and then giving us a reading saying, hey, inflation is going down if you don't mind the prices at the pump and at the grocery store. Besides that, inflation is going down. Now, does anybody believe or buy this garbage? Of course not. But we're seeing certain plateauing going on. For example, in the average hourly earnings, of course, your wages, if they go down, that's not a problem at all for the Fed. They actually want that because that is the core. When they talk about core, this is the core of their problems. They want your wages to go down. If gasoline prices stay higher, real estate prices stay higher, that doesn't matter. But it's your wages. That is the core of the problem for the Fed and the oligarchy. Import prices still high, but kind of moving down. But you cannot guarantee that this is a beginning of a downtrend at all because it remains too high for now. And when we look at even if we use the core PCE, for example, let's call the Fed's bluff. And even when we do that, the Fed funds rate remains simply too low. Now, remember, when Paul Volcker tackled inflation back in the 1980s, he raised interest rates above the CPI. That did the trick in moving inflation down. Let's say Jerome Powell says, I don't believe in the CPI. I don't believe I should take the Fed funds rate above 8.5% because I believe inflation is transitory. And by the way, Mr. Powell, I bet that he still believes inflation is transitory. So let's use the core, in this case, the core PCE. It sits right now at 4.9%, let's say 5%. To tackle inflation, the Fed funds rate must rise higher above 5%, at least, at a minimum. And this is all what I'm asking for, folks. I'm not asking for over 8.5%. I'm just saying get it to 2.5% immediately, which you say is the neutral rate, and then gradually, before the end of the year, take it all the way to 5, or as close as you can get. Now, you might say, Maverick, if they do that, they will cause a lot of casualties. Well, the casualties will happen either way. The question is, Do you want 5% unemployment or do you want 8% plus? Because at this point, the Fed is way behind the curve and there will be casualties either way. And economist Mohammed Al-Arian will explain that to you perhaps in a better way by the end of this video. But anyhow, any relief in sight here from, let's say, food at home, groceries, that is skyrocketing right now. And then you see, for example, hourly wages in orange, that's actually moving down. So food expenses moving higher and higher and higher. If there is any relief in the upcoming CPI, it's certainly not coming from food. But at the same time, your wages are lagging and moving down. And hence, we're going to see the stagflation crisis intensifying, and folks will struggle with the cost of living. Now, look at rent, for example, in yellow. They say that rent year over year went higher by 4.8%. Maybe in La La Land, in Fantasyland, because in reality, rents are moving higher by at least double-digit territory across the country. So again, when we say the CPI is masking the true nature of inflation, it is due to rent and housing costs. Had they used a correct formula for rent in the CPI, the headline reading, all in all, would be way above 8.5%, would be at least at 15 plus on the CPI. But because they manipulate the formulas to mask the increase in rents, the inflation in rents and housing, we see tamed readings in the CPI. And even with that, it remains right now at 8.5%, which is highly elevated. But the assumption for now, are rents moving higher or lower? Did they move higher or lower in the month of May? My hunch is it moved higher. We're seeing it all over the place. So the cooks at the Bureau of Labor Statistics can lie all they want. They can say rent inflation went down in May. In reality, nobody's going to buy that at all. So we're not going to see any relief from rent. What about services? Well, we know spending on services is moving higher. So if you're looking for any relief in the next CPI reading from, say, airfare tickets, that's not going to happen. And ladies and gentlemen, this combination of wages moving down, plateauing, and peaking and moving down, your wages are peaking. But besides that, food, gas, all moving higher. And this dynamic forces the consumer to spend more. And therefore, we're seeing exhausted savings rate for households. We talked about that in details in numerous videos. But we're also seeing consumer credit moving significantly higher, rapidly. Because you exhaust your savings, you have to use those credit cards to keep up with inflation. And this leads to higher inflation expectations. When your wages, your purchasing power is being reduced by the day, even if prices go down slightly at the grocery store or the gas pump, you're not feeling any relief because your purchasing power is being diminished. You might get a relief in, let's say, Home Depot, for example, but you're paying more at the gas pump. So all in all, you're worse than before, even though certain prices at Home Depot, for example, went down. And we're going to talk about that in a minute. But let's do this. Let's go over certain commodities and see whether the relief is going to come from any of these commodities in the next reading of the CPI. For example, in the WTI oil, in the month of May, prices went higher by 10.69%. So we're not going to get relief from energy. We know that for sure. And of course, economists are baffled. Why would oil prices move higher along with the dollar index, along with inflation? Because what we learned back in the 70s, when you have excessive money printing, devaluing the currency, you have inflation. So when you have oil prices moving higher, the dollar goes down. But we're not seeing this anymore. We're not seeing this phenomenon anymore. Matter of fact, we're seeing the dollar and oil moving higher together. And that is for multiple reasons. Number one, all in all, the United States dollar has actually been devalued. It is only relatively strong on the index because it is pinned against other currencies, and other currencies are weakening significantly, giving us the illusion that the dollar is strong. But in reality, it's not. Number two, the Federal Reserve manipulated all of this when they initiated quantitative easing, because now when we move into quantitative tightening, the dollar appreciates in value. The combination of the two is causing the distortion between the prices of oil and the dollar. What about gasoline at the pump, the RBOB? Well, the futures went higher by 13.7% in the month of May, so we're not going to get any relief in the CPI from gasoline. What about natural gas? Natural gas went higher by 12.5% in the month of May, so we're not going to see relief from here either. What about lean hogs? Lean hogs went higher last month by 7%, so we're not going to get relief from hogs, pork, bacon either. Wheat went higher in the month of May by almost 3%, so we're not going to see relief from food in the CPI. But we might get some relief from, let's say, copper, because copper went down in the month of May by 2.5%. But perhaps the majority of the relief will come from lumber. Lumber went down in the month of May by 28.58%, a massive decline. But you got to keep one thing in mind. When inflation in a certain commodity goes down, is it going down for the good reasons, or is it going down for the bad reasons? What do I mean by that? Going down for the good reasons, meaning supply caught up with the demand. But going down for the bad reasons, it means that the demand went down abruptly and in an impulsive fashion, while the supply remains nowhere to be found. Or now you're in a situation where supply actually exceeds demand, leading to prices going down, just like we saw with the case of Target. So you have some fools, like Jim Cramer, for example, saying the case of Target is proof for peak inflation. If anything, it is a proof for the upcoming recession. You don't want prices to go down for the bad reasons. So keep that in mind, bad reasons, because Mohammed Al-Arian will talk about it by the end of this video. But we're seeing lumber going down for the bad reasons. The demand in the housing market is collapsing by the day. Why? Mortgage rates are moving significantly higher, so we're seeing mortgage applications in a meltdown. Matter of fact, Liz Young says, now that we've seen mortgage applications moving down, even piercing below the pre-pandemic levels, now that means that housing prices will follow. I disagree with that. Here's why. Home prices are not going to go down until we see unemployment rising in the economy. And unemployment is not going to move higher by its own. It will move higher on its own gradually by the stagflation, but it will move even higher by the Fed increasing interest rates higher. So the Fed has to do the job here in creating unemployment, unfortunately, because at this stage, that is the only remedy, and they have to go over 5% at least to tackle this inflation, increase unemployment slightly in the economy, and relieve the housing market from the pricing pressure. Because when you think about it, even if the economy sours, even if inflation goes sky high, so long as you have your job, your priority will be paying your mortgage, your rent, and instead you're going to cut spending from areas that are not necessary. You're not going to go out to eat, you're going to cancel a vacation plan, for example, you're not going to spend on airfare, on hotels, etc., etc. But you're not going to stop paying your mortgage, so you're not going to leave your home. How is the supply ever going to catch up with the demand? How are we going to increase the inventory in the housing market without unemployment? It is unfortunate, but we only got here because the Fed was too late to take action. Had they raised interest rates last year, we would not be having this conversation right now about unemployment moving higher. What about fertilizers? Any relief here? Yes, there is, specifically nitrogen, urea. That moved down significantly, and therefore you're seeing certain fertilizer stocks struggling, like Mosaic, for example. I sold 75% of my position. I'm done with it, but I'm keeping Nutrien, and the reason is Nutrien is more in potash, and potash continues to linger higher, along with phosphate. So we have partial relief here when it comes to fertilizers. Now, is it going to show in the CPI in a meaningful way? Who knows? It has a smaller weighting. Energy and rents, those are the ones with the highest weighting in the CPI. Now, what about online prices? Yep, we got relief here. Prices went down in the month of May dramatically, so we might see some relief from online prices, online shopping, and therefore you're seeing all of these online platforms, the stocks of these companies crashing. They already crashed ahead of time, predicting that we're going to see demand destruction in online spending. But folks, at the end of the day, does it really matter what the CPI reading will be if it is down slightly month over month, if it is up slightly month over month? Does it really matter? Of course not, because it doesn't provide us with any information at all that we're seeing peak inflation in the economy. On the contrary, the reading we're about to get will prove that inflation is not peaking, and this is exactly what Mohammed Al-Arian says. The reading we're about to get doesn't matter because the reading in June is going to be higher. Take a listen.
What are you looking for from CPI in the United States tomorrow?
So I have no reason to have a different forecast from the consensus of 0.5 and 0.7 month on month. But what worries me, John, and you're not going to like this because it's looking forward, the June month on month print will be worse than the May month on month print. I think those who boldly said inflation has peaked and it's coming down may have to change their minds. I wouldn't surprise me if we see a headline print that's much higher than the 8.5.
Next month, Mohammed, why?
Not as early as next month, because first, the drivers of inflation are broadening, and that's due to the Fed policy mistake. Secondly, at the headline level, energy prices are going up month on month quite dramatically. And thirdly, we're seeing pressure on shelter and food. So if you look at all the components, it's way too early, unfortunately, to say that inflation has peaked. I hope it has, but it would not surprise me if we go above 8.5% on a yearly basis.
Now, here's a good one, so you might want to pay attention here. There are a lot of folks who believe that inflation is still transitory, and when they see prices going down in certain corners in the economy, they celebrate right away, assuming that this is peak inflation. But remember the little bit of, is inflation moving down for the good reasons or the bad ones? Here's Mohammed Larian once again.
Mohammed, this is really important. I remember when you gave me the call early last year, and you said, I don't think this is transitory. This is important. I'm pushing back. And you went out there in force, and that force got more powerful as the year progressed. I get the feeling this year, Mohammed, that we still haven't totally relinquished this idea that a lot of this is temporary. I hear from a lot of guests who think that we've seen the peak, a mechanical peak year over year, and for good reason. And they think the Fed backs away in September. Are you stressing this is going to persist through the whole of this year, that we're not going to get that drop-off that so many people are hoping for, looking for?
John, if we get a drop-off, we'll get it for the wrong reason. We'll get it because of demand destruction, and that would be tragic. The last thing we need is for inflation to completely undermine the demand side, because then we have not only a price issue, but we have an income issue. And once again, it will be the most vulnerable segments of the population that get hit the hardest. So in a way, be careful what you wish for.
So be careful what you wish for. In the case of Target, for example, that is inflation going down for the bad reasons. The oversupplied and the demand is getting crushed. So yes, they're going to push prices down, but it is due to the lack of demand. And hence, we're entering a recessionary environment. Sooner or later, Target can deny all they want, but they're going to be forced to lay off employees. It's inevitable at this point. Now, when it comes to the degree of pain that the economy has to endure in order to remove inflation out of it, it all depends on the Fed's action. You act now, and you act aggressively, as you should, the damage will be minimal. There will be damage. It will be felt, no doubt about it. But waiting and hoping that inflation is going to be transitory, you're only going to get more stagflation. And by the time you react and start doing what you need to do by raising interest rates dramatically, we're talking about the Fed, of course, you're not going to have the unemployment cushion in the economy, because by that time, unemployment would be at 5% by stagflation alone. Then comes the Fed by cracking up and raising interest rates higher. And now the unemployment rate moves higher from 5 to 8 to 9%. Now we're getting a deeper recession, because they're going to realize that in stagflation, yes, the economy slows down. We see more unemployment, but you still see inflation lingering. Here is Mohammed Larian once again.
How much of this is a Fed policy mistake? But second, they're going to have to be much clearer about that path. And you've heard me say this, much clearer about what mistake are they willing to underwrite. Because right now, they are so late, John, that there is no first best policy response. That was last year when you and I were discussing it. Now, it's about minimizing the mistake. And they're going to have to make a choice and stick to it. The worst thing is a flip-flopping Fed. A Fed that hikes rates and then pauses in September, then starts hiking again and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
And therefore, folks, I'm actually hoping for a higher CPI reading. Bring it on hot, hot, hot. You know why? Because by doing so, at least, we can rest assured that the Fed will not have the room for maneuver and weaseling around by saying, okay, let's do 250 basis points, and then we pause in September. If they get a hot reading tomorrow, they will be forced to face reality, and that is better for the economy and for the stock market. The more serious the Fed is, the better we feel as market participants, as participants in the economy. But when the Fed remains so callous and delusional, that doesn't give us any confidence that the Fed will indeed tackle the inflation problem. Anyhow, let's move on and cover the stock market for you, and we start with the performance of indices today. And here we go. The Dow Industrial Average down big by 638.11 points, or a decline of 1.94%. The Nasdaq down big by 332.05 points, or a decline of 2.75%. Likewise, the S&P 500 also in the red, down by 97.95 points, or a decline of 2.38%. The sector's performances, red across the board, a bloodbath. No relief here at all, and certainly no metals at all. Shame on all of them. But the declines were led by technology, materials, and cyclicals. What about the advance? The decline ratios, NYSE 12% advancing versus 85% declining. The Nasdaq 23% advancing versus 73% declining. Now, I know most of you are assuming that perhaps the CPI leaked or whatever, even if it didn't leak. The action that we got by the end of the day, the flush down, is an indicator that the market is going down because we have certain technical violations, which we're going to cover in the charts analysis. But be careful what your assumptions are. Because what if the action that we got at the end of the day is nothing but a bear trap? They're going to trap a bunch of bears, a bunch of shorts, and blast the stock market higher tomorrow because the CPI, the core CPI, the whatever CPI, went down month over month. Perhaps what we got by the end of the day is not a leak of the CPI, but maybe it is a psychological decision-making by market participants to de-risk ahead of the CPI reading. Anyhow, let's move on to commodities. What's going on here? Muted action for crude, both the WTI and Brent down by about half a percentage point apiece. Yet we're seeing the RBOB gasoline moving higher with modest gains this time around, a little over half a percentage point. And then we have heating oil moving higher, scoring gains for a little over 2.25%. Natural gas, the party boy, above $9 per BTU once again. And of course, when we talk about energy, we have to talk about the outlook for oil prices. We heard the folks from JP Morgan who said $150 a barrel coming. And now we're hearing from Trafigura, and they say that oil prices could go parabolic, putting the global economy in a quote-unquote critical situation. You have savings going down, you have debt moving higher, and the prediction is oil is going to continue to move higher. That's a lethal combination, folks. But rest assured, even though JP Morgan said $150 a barrel, but here comes the perma pumper, Marko Kukuranovic.
What a stupid son of a bitch.
Who've been wrong since October of last year. He now says even if oil hits $150 a barrel, Marko Kukuranovic predicts stocks will reclaim the 2022 highs. Wow. I wish Marko Kukuranovic was my math teacher back in high school. Yeah, you can get an F in the class, get expelled from high school, but you're still gonna make it to Harvard anyways. You got a shot, your daddy's rich. Anyways, back to the futures. What about softs? The massacre in lumber continues, down almost 2% today, but we have OJ reversing the gains and closing down by a little over 3% today. Cocoa was down by almost 1%, and then we have the gainers. Sugar rebounding, scoring gains of a little over 1.75%. Then we have coffee also with a rebound that produced gains of a little over 1%. And lastly, cotton, another rebound, this time around with larger gains of over 4.25%. Massive gain for cotton futures today. What about metals? Down across the board, modest declines for gold, but sizable one for silver, platinum, copper, palladium, all down big. Platinum was the outperformer in the last few weeks. Now it's down 4% in a single day. Meats, muted across the board, but we're seeing weakness in lean hogs, giving away another 3% worth of gains today. And then we have grains. The pattern in rough rice is not looking good anymore. It looks as a reverse, not a reverse, but an actual head and shoulder formation, and therefore rough rice is down by a little over 2% today. Likewise, we have a down day for canola, losing 0.75%. Then we have modest declines for soybean oil, wheat, and oats, while we have gains led by soybean meal, which closed the day higher by almost 3%. Likewise, soybeans futures scored gains of almost 1.75%. And then we have corn also closing the day positive by almost 1%. Moving on to the big casino, the options market. What's going on here? The volume is moving higher, but they're not buying calls as we would like them to do so. They're actually buying puts, believe it or not. Even in the new hottest table of Amazon, which finished the day at number 1 once again with about 1.6 million contracts traded for the name today. About 60% of those were calls. And at number 2, Tesla, the souffle, was higher. It was the outperformer today, but it closed in the red anyways. That is a bad signal when you reverse gains of a little over 2%. Regardless, the souffle table was busy at around 1.4 million contracts traded today. About 54% of those were calls. And at number 3, Apple, at around 1 million contracts, or about 55% of those were calls. Here are the unusual activities that took place in the options market today. We start with the SPY, or you guessed it, the SPY. They're buying calls this time around, the 432, so watch out here. The bears, assuming that we got what we got by the end of the day, is an indicator that the market will react negatively after the CPI. In my opinion, I see it as a contrary indicator, but we'll see. It all depends on the reading. But here we have somebody betting that the SPY will move higher. They bought the 432 calls for the expiration date July 22nd with expectations. The name could move higher by more than 7.5% by then. They paid around $2 a piece to enter this trade, all in all spending around $3 million. And then we have the ticker ARKKK for Tesla Witch Cathy Wood. It has been the leader of these rebounds that we get once in a while in the bear market, but somebody's betting that the party is over. So somebody bought calls in the SPY. Here we have somebody saying, it's over. The rebound is over. The bear market rally is over. The CPI will bring us back to reality. The Fed is way behind the curve, and they will have to tighten even more aggressively, pushing the valuations of speculative, high multiple names, likes of RKK, down even more. And in this case, they bought the 39 puts for the expiration date, July 1st, with expectations that the name could go down by more than 10% by then. They paid around $1.50 a piece to enter this trade, all in all spending around $1.3 million. Now, what about the ticker AA for Alcoa? Somebody's buying the $50 puts for Alcoa, betting for massive declines to come. In this case, the $50 puts for the expiration date, July 8th, with expectations the name could move down by more than 10% by then. They paid around $2 a piece to enter this trade, all in all spending around $1.7 million. Let's take a look at the chart of Alcoa. This is a weekly chart. We talked about the trend line. If the trend line remains intact as support, then no harm done. But once that support is broken, that is an ominous sign. It is not broken right now by a little. It's broken by a lot. I know we have one more day before the week closes, but I think I've seen enough here. Breaking the trend line is not a good sign. And even though we have the reopening of the Chinese economy, which should be supportive of aluminum prices, but the company has more headwinds than that, and the technicals are now showing more signs for trouble. And therefore, I'm out of Alcoa now, entirely. The whole position is gone. Am I going to get back in? Perhaps, at some point, but I have to see more signs of a recovery, not just in aluminum futures, but in the headwinds that the company is suffering from when we get the next earnings report. But I'm also watching the recovery in the Chinese economy. If we have more signs of a slowdown in that particular economy, regardless of the reopenings, then that would be bad for aluminum prices. Next, what about Meta? META. This is the new ticker for Facebook, the company formerly known as Facebook, now known as Meta. This is the lunacy of Mark Zuckerberg. He's destroying the company in real time. But somebody's bidding for a bounce here by buying the 220 calls for the expiration date, August 19th, with expectations that the name could move higher by more than 19.5% by then. They paid around $5.50 a piece to enter this trade, all in all spending around $4.4 million. Now, here's the weekly chart of Meta. You have the trend line. So long as it remains intact, so far so good. But if the chart breaches below the trend line, then we have another massive flush down coming. These trend lines are important, folks. Whether in Alcoa or Meta, it doesn't matter. Once they're broken, you gotta trust your gut and the technicals. What about the ticker SE for C Limited? They're buying puts this time around. The $70 puts for the expiration date, August 19th, with expectations that the name could move down by more than 15% by then. They paid around $6 a piece to enter this trade, all in all spending around $4 million. Now, we have the trade of the XLE highlighted here for the ETF for oil, but the spread for this trade is too wide, so we're going to skip on that one. What about the ticker ZEN for Zendesk? They're buying puts, the 65 puts, betting for a downside for this name, using the expiration date of July 15th, with expectations that Zendesk could go down by more than 6% by then. They paid around $4.20 a piece to enter this trade, all in all spending around $1.8 million. And at the bottom of the table, what about the ticker ZIM? This is for ZIM Shipping, a name that I still own because I bought it at the IPO, but it's not performing so good as of late. But here we have somebody bidding for a rebound, buying the $60 calls for the expiration date August 19th, with expectations that the name could rebound higher by more than 14% by then. They paid around $4 a piece to enter this trade, all in all spending around $1.5 million. Now, somebody asked me about ZIM. A lot of you asked me about ZIM, so here it is. Here's the weekly chart. We have once again a defined trend line. It was broken once. Here comes the confirmation. The confirmation came from a breakdown of a bear flag pattern. Now, if that is the case, where is the next relief in sight? For that, we use the Fibonacci support. We get at around, let's say, 51.30, which was support back then. We're almost there. The chart is almost there. So somebody's bidding for a rebound from this particular support. It could happen, but the chart doesn't look good, technically speaking. I'm just being honest here, folks. I could pump all you want, but once the charts start to look bad, technically speaking, I cannot sugarcoat it for you. Moving on to the heat map analysis. It is a sea of red, a bloodbath across the board, very few exceptions. The retailers of Home Depot, Lowe's, Costco, Dollar General, these were the outperformers, but all in all, it was indiscriminate selling across the board. What does that mean? At the end of the day, the algos freaked out for whatever reason, and they started dumping ETFs. The good, the bad, the ugly, everything. Is it an overreaction? It certainly could be. The knee-jerk reaction before the CPI. So in my opinion, there's nothing to see here. For all we know, this could be an overreaction and we see a snap back tomorrow. Therefore, I'm just staying with a big bag of popcorn, watching the show, not making any major trades at all. So let's talk about certain corporate news. We continue to watch the fiasco between Elon Musk and Twitter, and it's getting uglier by the day because Elon wants to back out of the deal using any excuse he can, at this point, of course, because he realizes that he offered too much, he shot his load prematurely, and now he wants to walk it back. Yet he wants to save face while doing so. So he now says, I'm going to walk out of the deal if Twitter does not provide the bots and the spam data. Now, the problem with all of that, legally speaking, to begin with, number one, when he made the offer, he did not do his own diligence. The assumption is he made his so-called final offer after making and conducting his due diligence. You can't ask for that after the fact. If you're negotiating the deal of buying Twitter, then you should ask these questions before making an offer. It is part of the process of doing your due diligence. But Elon did not do that. He just made the offer, and that's all there is. And then he gave a reasoning. His reasoning of buying Twitter is it is full of bots and spams. I want to clean it up. So now you're saying you're backing out of the deal because of spams and bots? The same thing that was motivating you to buy the platform. This is looking bad, legally speaking, for Reverend Elon Musk. And to add more pain to the misery, Twitter came out and said, okay, we'll give you all the data you want. Everything you ask for, we'll give it to you. Let's call your bluff. Because at the end of the day, even if they provide him with the bots data, he's not going to make the deal. Nobody's going to support him to overpay for a garbage company like Twitter. On top of that, he's risking his own Tesla stock, and that already went down. If he actually does the deal, it would be a suicide attempt. The collateral damage would be Tesla stock. We also heard news from Abbott Laboratories. They're involved in many scandals, among them the baby formula, of course, and now we know that there is a whistleblower, that Abbott Laboratories knew about the problem ahead of time. They did not take action. So this is going to be bad news for the company. And by the way, I think one of you in the viewers left a comment a few days ago saying, why am I bearish on Abbott Laboratories and medical care companies, or medical devices companies, I should say. I don't recall when I was bearish on Abbott Laboratories or any of the health devices stocks. I'm not sure when I said that, but I used to own Edward Life Sciences and I used to own Mckesson. I know these are not exactly medical devices such as Abbott or MDT, but we're still seeing some of these names outperforming the general market. For example, Thermo Fisher, TMO, down big, but it's still outperforming a lot of the technology stocks and certainly the indices. A lot of these names are cheap from a valuation perspective, but You also have headwinds, in this case for Abbott Laboratories. They're involved in this baby formula fiasco, so you don't want to touch it right now. What about the heat map for the ETFs? Again, a sea of red, bloodbath across the board. It didn't matter whether it is growth or value, both down. International markets across the board down. The EWZ Brazil down big, 6% today. So were Chinese equities, reversing some of the gains from the rebound. The FXI, the MCHI, all down big. Nothing to see here, folks. Pain across the board, with the exception being the UNG natural gas in commodities. But even uranium, URA, we had some tailwinds the other day. It reversed all of the gains. Something freaked out the market today. The algos reacted by dumping everything indiscriminately. And hence the question, was the CPI leaked ahead of time? We'll see. Moving on to the charts analysis, and we start with SPY, 30 minutes chart. What's going on here? We've been banded in a range for a while now. The support 410 almost, the resistance at 416. And we've been going back and forth within the same range since the month started. And the reason is we're waiting for the CPI. Now, the consolidation in technical terms is a process of gathering energy, and that energy will be released one way or the other after the catalyst, in this case the CPI, comes out. But now we got the break to the downside before the catalyst came out, or maybe it did, who knows. But let's assume that this is a reaction by the algos, by market participants, due to the psychology and the fear that the CPI could be too hot, and they overreacted. That means that this is a bear trap. Once the CPI comes out, you're going to see the market snapping back, and you will see the break to the upside instead, and hence the bear trap. But the break would be legitimate if the algos or certain market participants indeed got a leak of the CPI, and they know it's going to be too hot, indicating more aggressive Fed. Then the move is legitimate, and it's going to continue tomorrow, which means the support will be at 398 and the resistance at 405. Here's the daily chart for the continuous contract for the SPY. What's going on here? Obviously, a bearish break in the case. The case being the consolidation in a bull flag pattern. The assumption was the break will happen one way or the other after the CPI comes out. And in all likelihood, the odds say the break will come to the upside because this is a bull flag consolidation pattern. The move that we got today makes all of these assumptions scrambled eggs, because now we have the breakdown before the CPI, and we have it to the downside, losing the support of 4,100. Here's the problem, and here's the reason why I'm not removing the bull flag pattern for now, and here's why I'm keeping the support of 4,100, as if nothing happened today. What if what we got by the end of the day is a mere overreaction? If that is the case, then we will see a reversal higher tomorrow, and whatever we got today will not matter at all, and therefore it remains confusing. But the move is supported, technically speaking, because the volume went higher. The RSI is curling down. So is the MACD. It's about to produce a negative crossing showing red impressions on the histogram. If that happens, then we have the confirmation that this is for real. And therefore, I'm glad that I'm on the sidelines, not doing anything here at all. Some of you might be taking the risk, assuming that what we got by the end of the day will stick. You could be right, and you could be awarded for that. But what if you're wrong? Why not wait and see how the market actually will react after the CPI comes out? Here's the SPX, the cash index for the S&P 500. My line in the sand is 4,000, and this has yet to be broken, and hence the possibility of a bear trap. But if we see a break below 4,000, then we'll know that the consolidation was the bull trap. And now we have a bunch of bulls who assume that the bull flag is going to play out, eating massive pies right in the face. And hence the beauty being neutral for now. Let's move on to the Qs, the Nasdaq 30 minutes chart. What's going on here? The same conversation that we just had with SPY is applicable here in the Qs. It has been consolidating within a range, looping around back and forth. The resistance, we know it is 313. The support, you could say 307. You can even go down to 306. It doesn't matter. It is a zone, not a particular number. But in this case, when we zoom in to a 3 minutes chart, for example, my number, 307.41, has been acting as both accurate support and accurate resistance. And today we got double rejections. We got a rejection earlier in the morning, and then we got another one in the afternoon, and after that came the flush down all the way till the end of the day. And for now, the support becomes 299.28. Now I'm going to use 297.5 as support instead to be conservative. If that's broken, then we got trouble trouble here. The so-called rally, the so-called reversal, the so-called bear market rally, the so-called bounce, rebound, doesn't matter what it is over. But I'm smelling a trap, a bear trap specifically. I'm not sure why, but I'm feeling it. And I'm looking for any technical indicators to support this theory. And I can only find the RSI from a 30 minutes perspective being way oversold, meaning if the CPI comes out favorable, whatever that means, we will see a sharp rebound in the pre-market right away. Now, if that scenario happened, the test will be, we're going to see a pullback right away, right? If we get a gap higher, we're going to see a pullback, folks, booking gains, dumping right away, assuming it's going to reverse, whatever the reason is. Then comes the test. After the initial sell-off, the gap higher. Are we going to see a rebound? More dip buyers showing up and the chart closing at the highs of the day? That would be super bullish. But if we see a resumption of the selling and then the chart takes the previous lows, erasing all of the gains from the pre-market gap, that would be certainly super bearish. Here's the daily chart for the continuous contract for the NASDAQ. The same conversation that we just had in the futures contract for the SPY is applicable here. It was a bullish consolidation with the resistance being 12,766 and the support being 12,207. In this case, believe it or not, the Q's futures remained within range. Nothing happened today, no break whatsoever. Yes, we're seeing elevated volume. That is a good sign for the bears, not the bulls. Likewise, we're seeing the momentum indicators, the RSI and the MACD, curling their way down. That is another good sign for the bears, bad sign for the bulls. We're not going to know for sure until the support of 12,207 is gone, unbroken. Then we know, okay, we have the next destination at 11,689. If that is broken, boy, we have another flush down big one coming. Here's the IWM 30 minutes chart. We got a gap down in the morning. The chart lost 188 as support for good, and now it is going down in a retest for the support at 182.81. The same conversation is applicable here. What if this is an overreaction? Look at the 30 minutes RSI. It is becoming oversold, and we see a sharp rebound in the morning. Then we go back to the same conversation. After the initial sell-off of the gap, are they going to buy again, or are they going to continue to sell? Now, there are many scenarios we can brainstorm here. What if the chart opens gapping down, etc., etc.? But we don't have the time to brainstorm everything here. So we're moving on to the DXY, the dollar index. What's going on here from a daily chart perspective? Technically, it is above 103, which is a major win for the US dollar. But even though we're seeing the RSI and the momentum indicators in the MACD in this case moving higher, producing green impressions, in the histogram of the MACD, all of these are signs that the bearish momentum is over, but we're seeing a fresh, new, bullish momentum. But the confirmation would be not a technical confirmation, but a fundamental one, which is the CPI. If the CPI indicates that the Fed is still behind, and the Fed has to be more aggressive, then we will see the pop in the dollar continuing. We will have a confirmation that the recapture of 103 today was legit. But if the CPI shows that inflation is perhaps cooling down on its own and the Fed has to be careful here, not to make a mistake of being too aggressive, then the US dollar is moving down, regardless of what the technicals look like. And here's a piece of evidence that you cannot trust the move in the dollar today without the fundamental confirmation. Look at the action in gold. Even though the dollar moved higher, crossing above 103, which we would have assumed that would equal gold losing 1,840 as support, the Fibonacci support. That did not happen. Why? Because gold is, once again, the mature guy in the room. It doesn't make critical moves without being sure, without having confirmations. So as if gold is saying today, I'm not listening to whatever the DXY did. I will move down below 1,840 if the CPI confirms the move that we got in the dollar today. Otherwise, it could be a trap. Why would I lose the support that I have right now before I know for sure? Here's Brent. Crude oil, from a 4 hours perspective, what's going on here? We got to 124, so the bull flag played out, and now the chart is consolidating in another bull flag pattern. If this plays out, then we're going to go all the way to 129, which happens to be the next resistance. Here it is, the daily chart for the 10-year yield, which will be critically important tomorrow. From a technical perspective, we have a rebound from support at 2.7, number one. Number two, we have the momentum indicators moving higher and giving us confirmation that the bearish momentum in the chart is over, that we're seeing the beginning of a new bullish momentum. But the confirmation would be the CPI. The CPI indicates the Fed has to raise rates even more, then we will see this chart blasting higher, and this will be bad for the Nasdaq and the high multiple names, and vice versa, of course. So here's the TLT, a weekly chart, no update here. It is waiting and waiting for the CPI to make the next move, whether it's going to be an ABC pattern to the upside all the way to 125, or breaking the previous support and ending the hopes of any double bottom pattern once it breaks below 112.86. Here's the VIX from a 4-hour chart perspective. It went down all the way down to the support of 24.29. The chart consolidated for a little bit on that support, asking for sellers. Any sellers that are going to push us down to break the support of 24.29 for good. The sellers did not show up, and instead the buyers did. Of course, this analogy is not for real because we don't have buyers and sellers for the VIX, but all charts act and react the same way. And in this case, the buyers, the positive momentum showed up, and hence the rebound from 24.29. We have a mini confirmation in the MACD. This is the beginning of a bullish momentum in the VIX, and hence bearish momentum in the SPY. So if you're betting the equities are going down, you have support from the dollar, you have support from the 10-year yield, and you have support from the VIX. But you have yet to get the confirmation from the fundamentals, which is the CPI. Here's the VXN 4-hour chart. Once again, we have a pop. We have a little tick in the MACD showing green impression in the histogram, but we have yet to get a confirmation for that. So again, do you go with this? The Q is indeed topped for this rebound, and it's over, and down we go? I don't have enough information to say that for sure. What about Apple? A daily chart. What's going on here? The chart violated the support of 145, but it continues to hold on a reverse head and shoulder pattern. Now that goes out of the window if Apple breaks below 138.79. So for now, Apple bulls are still alive. What about Tesla? What's going on here from a 30 minutes perspective? The chart went down. It consolidated at around the support of 700, asking for sellers to move down. If the sellers don't show up, in this case they did not, then the buyers will. We will see a move higher. Yesterday we got the pop, and it stalled at the previous high, which now becomes resistance at 743.20. But today we got the pop above it. It held on as support. It gave it a good shot, but at the end of the day, the selling force was too strong, and the support of 743.20 now becomes once again the resistance. If that is the case, we go down to 700, and then becomes the battle of 700. In all likelihood, if we go down there, the bulls will lose, and the bears will win. We will see a break below 700. So the bulls must be hoping right now for a pop higher in the pre-market. The flush down that we got today by the end of the day is just a mere overreaction, because when you look at the chart from a daily chart perspective, the bulls are still alive so long as the prospects of a reverse head and shoulder formation are still alive. For now, they are, and the reason is the support of 700 remains intact. Once the chart breaches below 700 once again, then the reverse head and shoulder goes out of the window. What about BTC, Bitcoin? What's going on here? You're not going to buy until you see a successful crossing above 32,384. Absent of that, the next move is coming to the downside. Now the chart is losing 30,000 as support once again. Not a good sign here, but it all depends on the upcoming CPI. It is critical, it is decisive, it will decide the fate of these charts. We have a big move coming, folks. This is the calm before the storm. The CPI will cause a sizable move in tomorrow's action. So let's not waste any more time here. Let's catch some sleep, right? I'll move on to the conclusion of this video. What do we have on the economic calendar? In case you were asleep throughout the video, I'm watching the CPI, of course, but I'm watching the year-over-year and the month-over-month reading. I'm not watching any core inflation rate year-over-year, month-over-month. I don't care at all. Energy inflation matters, and therefore I'm watching the headline reading. Then I'm watching the ECB. We have Madame Lagarde speaking. We got some reactions today from the ECB, and the conference will be critically important, specifically knowing the fact that it's coming after the CPI reading in the United States comes out. And lastly, I'm watching the Consumer Sentiment Index from the University of Michigan. Now, the cooks at the Bureau of Labor Statistics will be busy in the morning. Busy doing what? Giving us a tamed, cool inflation reading. That inflation is peaking and inflation is cooling down on its own. It doesn't require a reaction by the Fed. This is all a fantasy, of course, but the cooks are capable of manipulating data, so we're not going to underestimate them. But with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend.